Some things you told us, you told us, hey, really want to know more about that board versus staff, like the roles and responsibilities. And I know that's relevant for a lot of you, not all of you, but for those of you that makes a difference because you have professional staff, we're going to make sure to focus on that. We also heard you say like, wait, how are we doing all this in this time of uncertainty? There's a lot going on. How are we making decisions to go forward when there's everything changing? And so this is actually the right session today to really talk about the myths of finance and fundraising, because that's really going to attend to that. So we want you to remember, we like hearing from you. So the I like, I wish, I wonder, we're trying to get it to stay upright and do what we can. Those are the notes in the back. It's our evaluation form. So you'll have Post-it notes on your table. Let us know, hey, I liked learning about this. I liked how you did that. Whenever you get a chance now or the break, just go ahead and put something up there. The I wish was like, oh, I really wish you would have done something different. Tell us, because then maybe we'll attend to it, make changes for the last session. And the I wonder is, I wonder about other things that you could talk about. So those are sort of the three things I like, I wish, I wonder, or you can just come up directly and tell us. All right. Could be, I don't know, that's not working for me. I must
work. I tested and everything.
I know, but I'm complicated. So.
Oh, I think I know why. No. Okay. All right. Well, I'll be here. And they're working on here.
No. Okay, I'm gonna keep talking. So fundraising and finances. So today's session, we're gonna talk about fundraising and finances. And so that's where we're gonna be here. And then the third session is all about our broader Washtenaw County ecosystem. So for today, I'm gonna walk you through how, oh, there we go. See, finances and thank you, and fundraising. And then try this again. Okay. Perfect. Thank you. And then the last session, that'll be later this next month. So hopefully that sounds right. Okay. All right, session format. So today, we're going to start this session. Greg Lewis will bring us in. We'll talk about finances, all the information you want to know. If you didn't get the materials in the back of the room, please make sure to do that so you can follow along. We'll take a break so you can get some more food, go to the restroom, whatever you need. I'll talk about fund development. Robin Little will join us and talk about life and legacy. She'll be joining us online because she's not here in Michigan. And then we'll have time for all of us to engage and talk, and we'll have moments throughout all the session today for you to engage because we want to make it interesting on a Wednesday evening. You're not just listening. The guiding principles, what we hope you take and think about and keep conscious of, seek to understand. We hope you came in with a sense of curiosity, ask questions, you want to learn. That's what we're here for. We hope that you engage with people you know and people you don't know yet. So please be, learn to talk to one another, introduce yourselves to people you don't know, and make it an engaging, communicative time. As much as possible, be present. So we all have things going on our phones, in our heads, but you will get a lot more out of today's session if you pause, lean in, and actually pay attention and try to be present as much as possible. That being said, if you need a moment to step away, go check your phone, go to the restroom, take care of your needs, do whatever you need to do, and then when you come back to your seats, be fully present. Don't forget the restrooms out behind me. You got to come in this door to come back in. Okay. All right. So we'll start things off with a quick round of introductions. I'll repeat, please be brief, but I want to make sure your voices get into the space and we'll sort of set the stage. So 3 things: your name, your organization, and something that inspires you to donate to an organization. What makes you want to give to a nonprofit? So I will start. We'll use the microphone and pass it on.
I'm Naomi Israel. I'm at the Ann Arbor Orthodox Dominion. And I guess one of the things that inspires me to donate to an organization is that I feel like it's serving a need in the community and I want to make that be more successful.
I have a question.
Yeah.
Are you talking about financial donation or more time?
Financial donation. It's not. Since it's finances and fundraising, we'll talk money. Time is not.
I'm Michael Weiss. I'm also with the Ann Arbor Orthodox Dominion. And what inspires me to donate to an organization that serves a mission that match my values.
I'm Compita Strompa. I'm from Beth Israel Congregation. I'm a member at large. Um, I think I'm just gonna second that I like the mission of our congregation, and that's why I donate. Hello, I'm Jennifer Russell. I'm also with Beth Israel, I'm the VP of Ed. My children are things that inspire me to donate to various organizations.
Hi, I'm Taryn Gao with BIC also. I think everything everyone else has said, and also I think when there's a place that I don't have time to donate, like time to, I will give financially.
I'm Steve Lieber from Beth Israel, and I think when I see something where I think my donation will make a difference, it helps.
Michael Simon, Beth Israel Congregation, and I'm inspired if I believe in the mission of the organization. And a lot of what inspires me lately are sustainability issues, but just the mission.
I'm Lavana Aronson, and we donate to organization that we believe in and their mission. I'm gonna break up the routine here. I'm Nat with BIC.
Oh, I'm with the JCC.
I
didn't say that.
I'm with the Federation, and you want my name? Annie Wall, thank you. And I donate to organizations similar to Michael that have a more climate awareness mission.
Yes, I can do it twice.
Good evening, I'm Alex Baum with JCC. Similar to what Steve said, I would donate because I think it can make a difference there. That's why I would give.
Bobby Levine with Huber Day School, and I'll go with my child. This is a great inspiration for donating, especially to Huber Day School where he attends.
You could say why you give, Craig, if you want.
I'm Ronnie Shapiro from Temple Beth Emeth, and I donate. I like what Alex said about making a difference, but I also donate for my community.
My name is Bonnie Keenan. I'm also, this is a whole TV table, yeah. Nothing like mixing it up. What inspires me is to make a difference and believing in the mission, all of that.
I'm Kathy Marshall, Team TDE, and yeah, what inspires me is not only the mission, but I also tend to donate to organizations where I have either a personal connection or some type of a personal direct reason.
Midge Cohn, Temple Beth Emeth. I was just looking at, since taxes weren't too long ago, the areas we did donate to, and a lot of them were areas that have touched myself, or through volunteering, or family members, or they've helped somebody I know in the community, and I'm incredibly grateful that this organization is there. Others are just because I believe in the mission.
My name is Natalie Glovich. I can't think of anything original to say other than, yeah, I donate to organizations that touch my heart or touch my family, or directly help people in need.
Did everybody? Oh.
I'm Nancy Mark, and I'm also from Temple Beth Emeth. Ditto on the donations.
I'm Tara Cohen, and I'll start the ARC or ARC, however you want to call us, table. I donate similarly to other people because an organization's values speak to me. Often it is a direct connection, and I like to know that the money is primarily going to the direct service to the beneficiaries and not lots of overhead, even though organizations need that too.
Good evening, everyone. My name is Serena Bash, and I'm
here at the ARC table, but I'm also wearing the Jewish Community Relations Council hat. And yes, everyone, you all inspire me. Yes, we donate to organizations that we believe in the mission and have that personal connection. And I'll also add that have an impact, or we think they're going to have a real impact and are good stewards of the donation.
I'm Gabrielle Pescador, the ARC, and I also give money to organizations where I believe in their mission and hope that the money is going to go to the people who need it. Hi, I'm Karen Cooper with ARC. I give money to places doing things that I would love to be doing and can't do on my own. And I check Charity Navigator.
Josh Simon with the Ann Arbor Reconstructionist, the full name. I agree with what most people said. I would just stress that I think, there's so much, you see so much need out there that it's probably giving more to things that touch me personally than kind of emotional response.
Hi, I'm Julie Norris. I'd say the last few years, I find myself donating to what I consider to be crucial organizations that are under siege.
Hey, I'm Dave with the AARC as well. And I'm a small and petty person. I think I donate out of spite. Often people do something shitty and we can put money going the other direction. And that makes me feel good.
All right. I like it. Thank you. I like your honesty. And I think we'll come back to this when we get more into the fund development. So I wanted to get you in the mindset, knowing that everybody gives for various reasons. And we'll talk about that as we go forward. All right. And that's where I'm going to pause. I'm going to turn things over to Greg Lewis, who's going to bring us into the finance section of today's conversation. So, and away we go.
I'll try to advance, but I'm just getting one thing.
Hello, everyone. I'm Greg Lewis. It's so nice to be here and to be able to talk with you about finance tonight. I'll give you my answer. I generically just donating in general. I do because I'm a Jew, and I think we should. So that's partly my answer. I want to take you back to the last time. A lot of people said they served on boards because you were asked. Right? That's how you got twisted into there. And to tee up what Carrie's going to talk about later, I would also answer I donate to organizations because I'm asked. So remember that, because when we get fund development, that can be part of the answer, I believe. All right, so this is me. I am a historian of science and technology, talking to you about finance. I was a consultant by trade, and I've been on boards for about 20 years, often in a finance role. But the big caveat is I'm going to talk about some legal things, a lot of finance things tonight, and they're kind of worth what you paid for them. In other words, I don't really have any formal training in this. It's mostly things that I've learned along the way. I do have an MBA from the Ross School of Business. They don't teach you anything in finance classes like what we're going to talk about tonight. So did want to just caveat that, especially on sort of the legal stuff. There's no legal advice here, right? You may need to follow up on some of that. But I am happy to talk with people more. Hopefully we'll have some questions and some interactive things too. And of course, because
sorry,
you're gonna
see, it did work.
Okay, that one did work. Because I'm a teacher, we're gonna do a quiz. Yay! Yay, teachers. All right, so this quiz is that I'm going to give you is self-graded, right? So congratulations, you all get an A. Self-graded, it is meant to be if you're a board member, it's about finance, but if you're a board member in any role, right? So this is not you have to be the VP of finance or the CFO or something like that. But I want to ask you a series of questions in the quiz and I'm gonna take you through them relatively rapidly, but grab a pencil, a piece of paper and write them down. Let's see if this actually does it.
So frustrating. I'll do it.
All right, so you'll move.
Sorry, I did.
All right, so question one. Question one takes a little bit of thinking. What are two questions that you should be asking your CFO, your VP of finance, your executive director about the organization's finances? What are two good questions you'd want to ask? Take just a moment to think about that. And I'll partly give you a hint. If you look at the next 6 questions, you might think, oh, that'd be a really good question to finance. So part of them are up there. So I'm going to move you forward. Second question, write down now, what is your organization's annual budget? And shame on all the finance committee people at TB if you don't know the answer to this one. What's the annual budget? Next is, how does that look this year relative to last year? Is your budget up? Is your budget down? And ballpark, like how much? Like, is it up a little by inflation? Or are you talking like 30% or 20%? So that's the next question. What's the budget? Third is, what's your significant sources of funding? So where does the money come from? And so here I'm thinking about things like dues or one-time donations, or if you get grants, or it could be, at least I know in some cases, a draw from the endowment. And of course, related to that would be how big is each bucket? Is it 50%, 10%? That kind of thing. So where do the funds come from?
I'm gonna try this again.
Yeah, you want to try it again? Yeah.
No, I'll just do it.
All right, take us to the next one. All right, so question 4. What percent of your annual budget comes from restricted funds? Now we're on 4A. So what percentage comes from restricted funds? If you say, geez, I don't know what restricted funds are, we'll get to that. So what comes from restricted funds? And obviously then there'd be non-restricted funds. And yes, those should add up to 100%. And then what percent of your assets are in restricted funds versus non-restricted funds? Assets are things like cash. You could have a building, you could have equipment, things like that. Next is, what's the major uses of your funds? I know, I'm making you go through quickly. So what are the big buckets? If you think about, what do we really spend our money on? Is it salary? Is it rent? Is it programs? And then, of course, you want some idea of like, our salaries 50%, or salaries 90%, or salaries 10%. Is rent applicable? What percentage do you spend on things like that? Number 6, and there's only 7. Number 6 is, what are your big strategic priorities from a funding standpoint? And so what do I mean by sort of strategic funding priorities? These are not the things like paying the light bill and the rent. These might be things like, oh, we have a capital fund because we need to buy a building. Or we are building an endowment. Or we need to endow a position, or at least fund a position. Or our rabbi deserves a sabbatical. We need to save up for that, right? Something like that. What are the top 2 or 3 strategic priorities? All right, and let's go to the last one is, how comfortable would you be if there were a major expense? And so when I think of major expenses, I think of things like, on the one hand, it could be, we have a really big donor who, for whatever reason, we lose. They move out of town, they get mad at the rabbi or something, like you lose a major donor. And the other could be the kind of thing like the leaky roof. Or, as I know, a lot of us have faced, recently, all of a sudden we say, boy, we really need some armed guards outside of our building because we live in a different world than we did a few years ago and don't feel as comfortable. And all of a sudden you've got an expense that's not in the budget, at least in that mission. All right, so those are the quiz questions. So let's just pause before I go into the next thing and say, what do you think? How do people do? Yeah, how many people say, raise your hand if you think basically I knew the answer to this. Okay, so about half of you had good everything. Anybody feel like, wow, I really didn't know the answers to most of those? Okay, so a few people, right? So these are all, my point of view would be, these are all questions that if you're a board member, you should have a reasonable answer to those kind of questions. Like those are the kinds of things that you as a board member should know about the finance, even though you're not on the finance committee or doing the finance. It's the kinds of things that go to the overall health of the organization from a financial perspective. And that's part of what I want to convey today that we're going to talk about is sort of what are the things that you should know about. So let's go to the next slide. And so you'll remember this for those, most of you were here from last time, right? These are the three things that if you're on a board, a nonprofit board, right? There's the duty of obedience, duty of loyalty, and duty of care. And I'm going to talk about each of those from a finance perspective. We are going to try, or I'm going to try, we'll see where the questions are, to spend most of the time on duty of care. Because that's the place that I think is a little bit the hardest. Like, how should I be helping the organization? What should I think about, right? When I think about duty of obedience, this is about legal stuff. What am I legally required to do? When I think about duty of loyalty, that one's relatively straightforward. It's about, I put the organization's interests ahead of my own. And most organizations do reasonably well with this. Like most of you have a conflict of interest statement that'll say something like, hey, I shouldn't be embezzling from the organization. Like, okay, right? And there's a few other things there. I'll tell you one example of something where, it's not total, I don't want to be totally flippant about it, but usually what I find is that most organizations, the big questions are over on duty of care. But as we go through the others, definitely ask questions as we go through. All right, so let's go to the first one. So duty of obedience from a finance perspective, right? If you're on a nonprofit that's not a religious organization, you have more obligations. So non-religious organizations have to file a thing called Form 990, which with the IRS, which is an informational form. You're obviously a nonprofit, so you're not paying taxes, but you have to publish that. Someone mentioned Charity Navigator, right? You can find them out there to see what the expenses and things are. You don't have to do that. If you're a religious organization, you're exempt from that, right? Likewise, you don't have to have an audit or an annual review, although I'm going to show you some cases where you actually do. But as a general rule, you don't have to do that. And you don't have to publish your financials, anywhere, right? Because you're exempt. The things you do have to do are a couple, right? So one is there's payroll kind of requirements. And there are some exceptions where certain clergy and stuff you don't actually have to pay Social Security on, but to the degree you collect like things like Social Security taxes, you have to submit those and send that money in quarterly. If you have restricted funds, anybody know what restricted funds are? Bonnie, you want to try?
Or what they are?
Yeah, what are restricted funds? Tell us.
They're restricted for a particular purpose. We have a flower fund. People can donate to the flower fund, you can only use it for flowers.
Yeah, so they're the donor restricted for a specific purpose, a specific way that they're the money is spent, or a specific time over the money, the way the money is spent. And I'll talk a little bit more about this. There's some obvious ones where there's a thing called a donor instrument. So this is where you sign a written document that says, I'm giving you this money for this purpose, but it doesn't have to be. A verbal commitment can be make funds unrestricted. If you have restricted funds, sometimes those are in a thing called an endowment. I'll talk a little bit more about that. But anytime funds are restricted, they are ruled by the UPMIFA, a document I know all of you have read continuously, right? The UPMIFA is the Uniform Prudent Management of Institutional Funds Act. Took me a long time to learn that. Unless you happen to be in Pennsylvania. Because it's a state law, but there was a model one, it was adopted everywhere. It does rule here. I'm in Michigan, and I'll say a bit more about that. Well, before I get into it, I want to say, if you're like, really? I have no idea. I've never heard of that, and I am the head of finance. That's okay. I found about this in year 4 of serving on a board where I was managing an endowment that was north of $10 million. And I had no idea, right? None at all. And then I learned about it, and so there is a little bit of trying to make sure that if you're informed and you try to do the best you can. But we're going to talk a little bit about the UPMIFA. And then you also have an obligation here under your duty of obedience to do things like prevent fraud, right? And so you should take reasonable and prudent steps to prevent fraud and to have controls in place. And that is the obligation of the board, to be thinking about and reviewing the policies and procedures that you have that are what are called financial controls, which is largely about how do we make sure that we're using the money in the way it was intended and that there aren't fraudulent things happening. All right, so
Greg, could you just clarify so that everybody, or I'll just clarify, like a religious organization would be a synagogue, but the JCC, the Federation, Jewish Family Services, we are not religious organizations.
You're not, right.
So I just want to make sure that for those people who are in those.
That's great. So if you're a 501c3, like a day school, right? Even though it's a religious day school, 501c3s are required to make those. But if you're like a temple, you're not.
To file tax.
To file our tax.
File and to have an audit if you're above a certain size. Yeah.
You say, whatever, whatever. Is that just for religious organizations? That's all nonprofit?
No, all nonprofit. UPMIFA? Yeah, it's all nonprofits. All nonprofits. Yeah, funny.
I had a question about state law. You said Pennsylvania had a law. Does Michigan as well have?
No, Pennsylvania is the only one that hasn't passed the UPMIFA. So it was designed federally, but then it's adopted by the states, and 49 states did. So all states except Pennsylvania.
Okay, so there isn't any additional state of Michigan?
No.
Okay.
No, there's not. On the audits things, it's 300,000, you have to have a review, and 500,000, you have to have an audit. If you're with a nonprofit, like Hebrew Day School or something, it's not religious. Okay, let's go to the next page since we were being asked there. So this is way more than you probably want to know, but it is kind of good stuff to know. The UPMIFA, so this Uniform Prudent Management Act, right? It's charitable institutions have to manage and invest donor restricted funds prudently, focusing on total return, so appreciation income, rather than just interests. And here are the things that it mandates. And so let me say a few things about each one of these, and then you can ask questions about it. And this may be a place where you want outside advice, right? So prudent management, what does that mean? Well, there's the obvious, right? Hey, I don't want to see that the money like disappears or something like that. But if you were to take funds that were given like for an endowment and you leave them in your money market funds, that is not prudent management. That would not pass the bar for prudent management, because you need to be investing in a way that the intent of the fund, like if somebody gives you $10,000 today, that equivalent of $10,000 20 years in the future, when it should be much higher, is still having that same impact. So that's what it means when it says you gotta think of total appreciation, right? Not just the interest. Likewise, you have to have a policy that if you're gonna spend part of it, which you often do, you can't spend more of it than would be prudent to keep the capital that was given to you and preserve that. So that sounds really complicated. So I'll give you kind of the simple rule. The simple rule is 3 or 4%. This is about what you can spend in any given year. Because if you invest it, and the way they get there is 3 or 4%, now add inflation, and you get to 6 or 7%-ish. And if you're investing it prudently, you can get 6 or 7% a year as a long-term average.
Is this
Yeah.
only for endowments?
No, this is for any restricted fund.
Even if you're spending it down.
Yes. Any restricted funds. And endowments can be, and I'll talk about this in a moment, endowments can be composed of restricted funds and also non-restricted funds. So I'll talk to you about how that happens too, with endowments. But anytime funds are restricted, which means they've been given to you by a donor with restrictions that donor put on it, then you're governed by this. So that's prudent management. You have to have investment policies in writing. You have to say, what are our policies about investments? That includes things like asset mix, who's actually going to be managing your funds. You do have financial reporting, which you need policies on, and you do typically need an audit for that, an annual independent audit. You need policies about how you're going to spend the money. And you have an obligation around diversification. So those are the major kind of things that are in there. So and I'll take a question in just a second. So what do I really take away from all this? Because that sounds complicated. The things for you to know are, number one, is it is complicated. So that requires financial oversight if you have restricted funds. And then, as Naomi said, a lot of organizations say, I'm so happy to have the money. I'm glad you have $100 and you want me to do it. I'm happy to do it. And now you're going to do an annual audit and all these things. So one of the things you want to do as a board is set the number at which, if you're not giving us X, we're not going to allow you to put restrictions on the fund. It's going to go to, you're still giving it to us. We're still going to spend it in accordance with our mission. But whether or not we spend it to pay the light bill or salaries or something else, that's up to the organization. We commit to spend it consistent with the mission. And typically the place that I find people get in trouble is that number is way too low. Way too low for most organizations. For the ones that are in this room, like I'm on a board of another organization. We are $500,000 a year budget. And we do not accept restricted donations under 50,000. So if it's not 10% of our annual budget, we won't take it. Restricted funds. And that's the policy. And I agreed to it because everybody else voted for it. And I couldn't I think it should be higher than that. I think it should be more like 100,000 more. All right, there was a question.
Yeah, I think this is a follow-up from someone else asked, but if a donor gives restricted funds that are specifically for a short-term project.
Yeah.
The intention is that you're gonna use this money for a certain thing that will be done in a year.
Yeah.
So the prudent management seems to not apply exactly the same way, right? You're not trying to invest and look for appreciation in that case.
Well, it still applies, but you're right, it's not appreciation. So there, the restriction would be, hey, I want you to spend this within a year. So then prudent management would say, don't put it in the S&P 500. That would be a bad thing to do because, all the investment managers would tell you it's too volatile and all the rest. So in that case, you could say, oh, the prudent thing to do is put it in cash or maybe in a money market fund, and we're going to spend it over this time. So I need to have a spending policy that's consistent with what that's going to be and how we're going to spend that. And then I'd need some sort of reporting and all the rest. But you're absolutely right. Yeah, if you're going to spend it every year. Naomi, you were going to.
Yeah, I was just going to ask you, so where does I guess I have two questions. One is grants are not considered in this, right? A grant that's for a specific purpose does not trigger all of this, right? It's just individual donors giving to an organization.
That's a great question. I think that's true. I believe that is true.
That's right. I just want to make sure. And the other thing is when you have things like flower funds or kiddish funds or something like that, where you're collecting money in a bucket that you're going to be using, does that also trigger this, or is those are restricted, right? So be very careful with those things.
Yeah, that's exactly right. Yeah. That's the way I see it. Now it's a little bit gray, right? Everybody put a quarter in the tzedakah box and it was intended to buy candles and then somebody bought matches instead. Oh no,
Right.
like, so I think there's a little bit of like leeway in what that does, but in general, yeah, you want to be careful with what you promise people, right? And so the example I give, I think is a little bit trivial, but yes, all those things that you go where somebody says, oh boy, we have this need, here's, some money, well, we promise to use it for that, well, then you do have this. It most often gets when you think of things that are slightly longer term than things that are specific for spending in a particular period of time. My view is if somebody gives you $25,000 to buy, I don't know, new tablecloths or something, and you take the money and you buy the tablecloths and you kind of done, right? It's not, that's not as, that's tough an issue. So, yeah.
Like you were imagining that we all do these small restricted funds.
Yep.
We have the rabbi discretionary fund, we
Yep.
have the Torah repair fund.
Yep.
If we not, does that acronym, MIFA?
Yeah, the name of that.
If you just have the policy that it stays in the name,
That wouldn't meet the bar for prudent management.
doesn't make the bar for.
That's right. And here's the argument that they would use. So let's say I give you $20,000 for a Torah repair fund, and we want that to be used for the safer for, forever into the future, right? That's the idea. We're setting up this fund. And $20,000 today, say, I'm making it up, is enough to repair one scroll in total. If I think 50 years in the future, that'll be $200,000 to do one scroll. And yet I've got to invest that $20,000 so that it gets me to that $200,000 in the future, because you're supposed to be managing it with the intent that the capital was gives you the same impact. And so you are required to.
I mean, but just to clarify, like on the rabbi discretion, this is not necessarily a donation of somebody external, this is funds that we.
That's different. That's right.
That's.
Okay, and I'll talk.
So if he's talking about something, that's why these are funds that we buy.
That's right.
But the donor.
But wait, that's a great clarification. So.
Designates.
Well, in the rabbi discretionary fund?
There's
Someone can go online and say.
Oh.
They go online
Yes,
and they.
that's right.
donate
And
button,
it's restricted.
Drop down menu that says,
That's right.
is this your dues? Is this a?
That's right. You're absolutely right. So in that case, it's from the donor. Now that is different than if the board were to say, hey, we want to set $20,000 aside to fund the rabbi's trip to Israel.
So we have.
And then something happens in Israel and he cancels it and you say, you know what, now we want to use the $20,000 for something else. The board votes to it and it moves it somewhere else. These are from donors that you're talking about, the donors. Yeah.
Did I hear you say that in restricted funds need to be in separate bank accounts?
No, they do not need to be in separate bank accounts.
So it's really just an accounting function?
That's right.
Okay.
That's right. And often they are commingled.
Right.
Often they're not in separate accounts, they're commingled. Yeah.
Go back to the example you gave about the core repair fund. So someone
Yeah.
gives you $20,000. If the tour needs to be repaired like that year, then you use that fund, right? Are you saying?
Well, so let me give you a better example. Let's say somebody says, look, I understand we need to repair our Taurus all the time, right? And we say, hey, it's $20,000 to repair one. They say, great, I'm gonna give you $400,000. The reason for that is 5% of that is about 20,000. And so with that 400,000, you should be able to every year have $20,000. So you can do one per year if you needed to repair the scroll. What you can't do is then leave the 400,000 in cash. And 50 years from now, the saver says, you know what, I charged 200,000. And all of a sudden you say, well, I can't use it anymore. The prudent management means, okay, I could invest this in a way that'll get me a 7% return. That's not a crazy kind of conservative return. We'll take 5% out and pay each year, but the prices will probably go up 2% a year. And so then that'll match. So I can have the same impact 50 years from now that I could today. That's the idea. And that means we tend to think of prudent management with investments of like, it's in cash, right? That's prudent. And the point here is that's not necessarily prudent from the way in which it would be viewed through the act.
Is this
Yeah.
something that an audit would catch?
It should. They didn't on the 10 million that I was managing.
They didn't.
They didn't, right? So, but we figured it out and got there. So there is, this is not like the sheriff's not gonna show up saying, what, you have $1,500 in the flower fund and you haven't been doing it? Like, probably not. But there is, I think the two things here are, one, some familiarity with it. Like if you're the general board member, what you wanna say is, thank God I'm not the VP of finance, because they need to figure this out, but it might be a question you ask them. And then I think where the boards drive people crazy who are on the finance committee is over here on setting the restricted fund amount too low. Yeah. Yeah.
Part question for you, part for Eileen, you just spoke to our board about how the Federation manages some of the endowments that our organization has from many, many years ago. Some are restricted, like there's some usable instrument endowment or whatever. Do we have documentation from you, or can you get that says that we're in compliance with this for those restricted funds? Do you think that it's a way?
Yes, because the foundation is managed by the Pittsburgh Jewish Community Foundation. We know we have information about their investment policies. We also have we also have the original founding documents, or sometimes with amendments that say how the money is to be used. And we have an audit every year that includes our foundation holdings. But also, obviously, the Pittsburgh Foundation does have an audit.
So your obligation as the board there would be to say, hey, let's just make sure they're doing what they said they were gonna do. Like, we don't have to manage it. But if all of a sudden there were a news announcement that, lo and behold, down there in Pittsburgh, one of them's now living in Brazil and took half the fund, and all of a sudden you gotta say, wait, now it's my obligation to review and make sure.
But I also think spending policies are, the spending policy is important. So one of the things that we did at the foundation is set a spending policy for how we will use the fee funds, right? So for particular purposes and particular ways. And then each fund, whether it's an endowment or not, the documentation indicates what the spending policy is.
All right, Scott, I'm gonna say another question, but take us forward one, because I'll go to the next one. But yes, you got another question.
Yeah, so, this is a little speculative, I guess, but so what happens if you have restricted funds from a donor that are for a specific purpose? If you invest it prudently, you're letting it grow over long term. And after 20 years or so, the need for which it was given is moot.
Yes.
You no longer need the money anymore, right? But you can't use it for anything else because it's restricted funds. Then what?
Yeah, that's a great thing. Then you get together and you go to the Attorney General of the state of Michigan.
Wow.
And you must apply, and you must say, here's a very good reason why it should be funded that way. Like, I'll give you, I think, a real world example. Here's restricted funds to buy books for our physical library. I don't have a physical library anymore, and so maybe you go and say, okay, they're gonna pay for digital subscriptions or something, or there's no need for that, but it does require a sign off by the Attorney General to make that change.
But
And
also,
so it's complicated.
also in your forms, like if you set up a fund, you can say, if this purpose is no longer needed, then, it can be changed by, a vote of the board, or if the organization's going out of it. So there's things that you can put in there. And if if your donor is still alive, you can go to the
You
donor
can
and
get them to
say,
change it.
Yeah.
Yep, you can do that too. It's a little harder if there's 20 donors to a single
Right,
fund.
right.
Or something, but yeah, why not have the little thing that says, this is for this specific purpose for the rabbi discretionary fund, unless we decide we want to really use it for something else.
Does it to be a restricted fund if it's worded in that way?
Yeah, those caveats.
Yeah, like if it's given a caveat, like.
No, it's still technically a restricted from the standpoint of all the requirements of the MIFA, but it gives you flexibility in terms of how you can actually use the funds. But it's still restricted. Yeah. All right, let me cover a couple of these and then I'll ask others, because a couple of these have come up already. So restricted funds, these are given legally binding, donor imposed stipulation, how, when, or for what. So that can have a timing, how it's spent, what it's used for. And typically in writing, like if you think about, the people you hear about who are naming buildings who've given $2 million to EMU or whatever, they're almost certainly going to have a donor instrument that's written up. But oftentimes, even if it's a verbal, it's still binding. All right, true endowment is a permanent invested pool of donations that are for the long term to support the organization. That could be restricted funds or unrestricted funds. You could just say, look, I want you to give to the endowment. It's going to go in and the endowment's going to support the mission. But commingled in there could be, no, I'm going to give to your endowment, but this is restricted. I want it used only for the school, to support the school, for example. And those both could be in an endowment together. And then there's what's called quasi-endowment. So the board could say, hey, here's some money that we want to put in the endowment. Like I was on an organization that 6 years in a row, we had an operating surplus. We had, an extra $150,000 a year that we were getting. And we said, look, do we want to just sit it around in our operating accounts and the checking account? And we said, no, we want to put that in the endowment and earn a return on it. Well, the board could then later come back and say, okay, now we want to use it for something else. That's why I call it quasi-endowment or board-directed endowment. And that's not covered under the UPM IFA, right? And you might want to say, well, why on earth would you do that? Well, in our organization's case, otherwise, it was just up to the CFO. He could spend it any way he wanted. I mean, not really any way he wanted, but by putting it into our endowment, we had to have a board vote to take it back out of the endowment to do something with it. But if it's a board directed, as you were saying over here, if the board just decides to spend some money and decides to put it in the endowment to invest it, then that you can undo because that's not a restricted fund. And endowments typically have some of both. All right. That'll move us forward. Any other questions on that? I know that one's a lot. It's by far the most complicated.
We follow up, can they?
Yeah,
follow up
absolutely.
with that?
Absolutely. All right, so let me talk briefly about a couple of others that I think are a little more straightforward. So fraud, none of us want fraud, right? Nobody wants that. It is your obligation to make sure that you take reasonable steps to prevent fraud and have reasonable financial controls. And here's a couple of things, right? Different people who do the accounts payable versus receivable. Why do you do that? Well, because you don't want one person sending their own made up bill to themselves and then paying themselves out of your funds, right? So typically there's like a different person who controls that. Or, hey, if we're going to write a check above X dollars, 1,000, 10,000, 8,000 or whatever, we need multiple signatures and we need some process. And you have a policy for what levels those are set at. Periodic independent reviews and audits. If you have restricted funds, you have to have them because the UPM IFA says you do. But if you don't necessarily have to have one, but you might want one anyway. You might want one just because the advice that we get is good. So those, I think the fraud stuff is fairly straightforward, right? Reasonable steps on that. All right, let's go to the next one. So duty of loyalty. This is the one where you have to put the interest of the organization ahead of your own interest, often covered under like a conflict of interest thing. But it doesn't have to be fraudulent. So I've tried to give an example here. I mean, let's say you need some legal advice, some documents drawn up or something. You have someone on your board with the organization who happens to be a lawyer. They know you really well. It's very efficient to like work, with them. That could be perfectly okay. By the way, they might donate their time, but I wouldn't as a board member assume that. I mean, they gotta feed their kids too, right? They're trying to make a living. And so you could say, hey, that's okay. We want to do that. But that's often disclosed on a conflict of interest form, that you have this relationship and it's transparent and the board monitors it so that could happen. Most of the time, these conflict of interest, if you sign them, are the things where you say, yeah, I don't have any business relationship with the organization, but there could be instances where members of the board are also a vendor or providing services or products to the board, and that's okay. But you do have a duty to manage that as a board and to overlook that. That's the main one on this one. Any questions? Yeah, on this one. Yeah,
I have an example. We actually had to make sure that we put somebody on our finance committee who's a CPA. And we had to make sure that he was not, he didn't have any clients that were within the temple. That he works for the Department of Defense.
Or you disclose that.
Yeah.
I mean, it could be you investigate, he has one, client, right? Kind of thing, right? And you disclose it and that that, takes care of it. Yeah, yeah.
So, we recently adopted a conflict of interest policy, and we have been discussing whether we also need a conflict of commitment or non-financial conflicts, right? So I don't know if that fits into this presentation because it's non-financial, but you have a situation where a board member might be on more than one nonprofit organization.
Yeah.
And they're not making money off of anything, but their fiduciary responsibility to one organization could interfere with their responsibility to another organization.
Yeah.
Does that fall under the duty of loyalty?
Yeah, I think it falls under the duty of loyalty. I'm not sure it falls under the finance perspective, but like, I don't know, if a Catholic priest said they wanted to be on my temple board, I'd be like, does that really work? Like, how would, I can imagine things where you could have some sort of conflict in terms of the commitment that's not monetary, but that is, in the business world, they'd call that competitive. Like, you wouldn't be on a competitor's board as well as the companies that you're serving. We're not as competitive in that sense in nonprofit, but you can imagine commitments that you're putting the interests of this person. Yeah, see that. All right, let's go on to duty of care, because I think that's another place that's interesting. Yeah, go ahead.
I have a question about audit.
Yeah, go ahead. Go ahead.
We're told that there's different levels of audits. It's true audit.
Yeah.
Everybody said they gave $15 to the flower fund, should be asked to really do it. Are there other?
There are different levels. Alex probably knows more about this than I do, but at least for non-religious organizations, I believe the law in Michigan is if you're a charitable organization, like 501c3, you cross you're under 300,000, I think is the limit. You don't have to have an audit or a review. If you're 300 to 500,000, you have to have what's called a review. And if you're above 500,000, you have to have an audit. What's the difference? Well, I think of two things. Number one, the bill you're going to get from the CPA firm is going to be different. An audit's going to cost more than a review. Moreover, the level of assurance that they're giving you about how they've looked at your books is different, right? And that goes more to the way CPAs and stuff practice. But there are certain professional standards of what they have to do under an audit that under review are in layman's terms easier, so they put in less effort, so your bill is lower.
So it might be reasonable for a religious organization to have
a review, not an audit. That's right. That's right. Did I get that roughly right, Alex?
Yeah, absolutely.
Okay.
We're talking about that right now in Temple, right?
Yes. Yeah, what level you need.
Why should we do a review? Why should we do an audit? Is it worth money? Is it worth the effort?
Right.
Yeah. You're saying that you understand that under Michigan law, like Hebrew Day was a 501c3 is mandated to have a full audit every year if our budget is over 500,000.
Again, I'm not a lawyer, but yeah, that would be my understanding.
Okay.
Yeah, that would be my understanding. Alex, do you know anything? That sounds reasonable. I think so. I think that's what the rules are. Yeah.
JC does an audit. It's a lot of work.
It's a lot of work.
It's a lot of work.
Yeah, I mean, I could be wrong, but I think so. And audits are 10 grand and up probably. We just easily.
Yeah.
Yeah. Yeah.
It also takes up an audit, takes up a lot of the staff time.
Ton of time. Ton of time. It's not a trivial exercise. Yeah.
Don't want to do it during the high holy days.
Yeah. Right. Another reason to follow Naomi's advice and not take prescription funds. All right, let's go to the next one. Here.
Sorry.
Low battery.
Wait, yeah, we're working on it. Wait.
Okay. Well, I'll talk to you about the next one. You've got
move?
slides there. I'll just look.
Why would it move?
All right, so what I was going to talk about first on duty of care was back to some of the feedback that we got before around what does staff do versus what does a board do? And so I think of it this way, and it's on the slide that you'll have there, right? There's the notion of bookkeeping, right? Or what accounting does. And at least the definition I looked up said, accounting is the systemic process of recording, organizing, and maintaining an organization's financial transactions, including things like bank account reconciliation, accounts payable, receivers, general ledgers. That's accounting. By and large, that's staff work. Now, if you have a really small board, you are the staff, right? So that's your work too. So this has to get done. Like, don't get me wrong, this is important stuff. But if you're a governing board, that's not your job. That's staff's job. And being over here is micromanaging your staff. Finance is the process of raising, spending, and investing the funds. It asks questions like, do we have enough funds developed for us to be able to do things like carry out our mission? What's our budget? What's our long-term forecast of the priorities that we have? Are we on track or not? That's finance. And that's a board area. That's what boards should be doing. So if you find yourself doing the accounting stuff, you're probably down at a level that you shouldn't be, unless, of course, you're on a board that is also an operating board, because somebody does need to do the accounting and the bookkeeping parts as well. All right, let's go to the next one. That's working.
Yeah.
All right, so I want to do, there's 4 things that fall in this duty of care. I get 3 and Carrie gets number 4. Okay, number 4 is really all about ensuring adequate fund development. So that's the fund development. All right, so I'm going to talk briefly in our time about each of these first 3. All right, so let's go to the next one. All right, so you've got this in your pages if it's easier to see there. This is understanding your organization's finances. And so I put together kind of a simple, what sometimes I think I called it, I didn't call it profit and loss. I called it statement of activities. The statement of activities is what in the business world is called a profit and loss statement. And by the way, there is a handout that has a whole bunch of financial terms in it to just help you with that, a glossary of that. But here it's called statement of activities because we don't think of profit because we're a nonprofit, right? So here's your basic thing, right? You've got your revenues up at the top for 2 different years, and their fiscal year, FY's fiscal year, as opposed to calendar year, CY, is July to June. So they start on July 1st and they go to June 30th. And this is the money that they're getting in. You see member dues, et cetera, et cetera. Expenses, they have 3 buckets. They have salaries, they have program expenses, and everything else, just to keep it simple. And here are 2 years of the budget. And we're now in December, so we're 6 months into the year. So this is what's going on. This is their actual. So the question is, how are they doing? So take a look at this. Tell me how they're doing.
Not very horrible.
They're not bad.
I think this is on
32 grand in the hole. And they only have a reserve then of 35 grand.
They have a reserve right now of 86,000.
But that doesn't count the fact that they're 33 behind, right?
Correct. So they'd have to pay that 33 out of the 86, so they've got 55 grand.
Yeah, I don't think they're
Question
going.
is,
How are they doing? What would you're a board member and your VP of finance just brought this to you and said, great, we're going to review this at the board. And I say, so what do you think? What questions?
Well, I guess I wanna know, did something happen, like suddenly like the boiler blew up? I mean, I don't
Okay.
know, like a once in a.
It's a great question.
Kind of a.
It's a great question. Great question. What did happen?
They lost 30 members.
It's the member, yeah.
Yeah, so you can, from this, you can tell what happened. That's the point. You should know what happened.
But can I just point out that you're also, you're looking at this at halfway through.
You are. You're only halfway through the year.
So you're halfway through the year. Maybe you may have different, like timings of when you do
That
certain
could be.
things.
Sure, but that second row in the revenues is specifically high holiday and year-end donations. So
Yeah.
by the end of December,
Mm.
you should have all of that in hand. Like, you're not waiting for more of that.
Okay.
The holidays have passed and the year-end donations
So they
passed.
didn't meet that donation.
So you're
Okay.
way behind.
Thank you. So that's one thing that's definitely going
And
on.
expenses are higher than you projected. I mean, provided it's evenly split over the year. Like
Okay.
half of the year, you're gonna be one
Expenses are about half.
So there's another question you might have for the VP of finance. Are these expenses expected to incur just like this? Are they gonna double? So that's another one. Yep.
Would I wanna see the equivalent of the year before?
You could, but you wouldn't have to, but that might be an interesting thing to say, because that might be helpful. What else? What else is going on? These are all good things, right? These are all the kinds of things you want to be looking at. The board member.
I mean, they've obviously got an endowment,
They have an endowment.
a big one, because they're getting $100,000 each year.
Okay, they have about a $2 million endowment. That's right. I didn't show that here, but they're getting a 5% draw. Yeah. What else?
I guess I'd also really wonder why we thought we were gonna get about 60 grand for a donation.
Yeah.
When the year before we got 36 and this year we got 35, it looks like 35, 36 is the.
Reasonable question to ask.
Giving Tuesday didn't work out or something.
Yeah.
We just plug that number.
And also the
But I would have just carried over the last number. Right. I think that.
Unless they had some grand plan, the whole, the size of the.
Very obvious projections there.
All right, so let me point out a cut just in the interest of time, but this is the kind of thing you as a board member should be doing. Like at this level, you don't need to be at the, why did we spend $150 on flowers and not 125? That you shouldn't be asking that question. But here you should be looking at things like they planned, if you look in their budget, they plan for a decline in members of 5%, but they actually had a 10% decline. They planned for a 5% increase in family dues. So they expected family dues to go from 2,000 to 2,100. And then they budgeted in $2,100 for 570 families. But instead they got $2,000 for 540 families. So their revenue there, if you think about it by monthly, the revenue is going to come out to $1,080,000. So they're over $100,000 short on the dues line. Okay, so that's a big deal, right? Next, I would point out, you're absolutely right. High holidays and year-end donations, don't look at that and go, oh, this is great. We're halfway through the year, we're going to get 70,000, except you're done. Right? Absolutely, that's what's going on there. The budget called for a 66% increase here in this line, right? And you've gotten it's basically flat, right? Salaries and benefits. Salaries and benefits were expected. They plugged in like a budget does, 4% increase. That's what we thought. Inflation, 4%. Then your staff said, you know, I'm worth more. And they're up 10%. Right, so when they went to negotiate, that went up 10%. Program expenses expected to be flat, but if you double that number, you're going to get they're actually up 4%. So our program expenses are high. If you do all of this math, and I project it out another 6 months, their expected loss is $207,000 for the year. And as somebody already pointed out, their reserves are woefully inadequate for that level. And in fact, you might have said, wow, $70,000 in reserves on a budget that's 1.3 million. So that's 4 to 5%, something in there. That's probably too low, to say the least. So my point here is, this doesn't look great at 33,000, but if you dig into this at all, you're going to go, we are in trouble. We got some real problems here. You've basically got all your expenses kind of going up a bit, and you're declining membership, and you're flat in terms of where your revenue per unit is. Yeah.
Is there a sort of guideline for how much of your budget you should have in cash reserves? What percent? I mean, you just said 3 to 4% is too low.
Yeah. So there's, I don't think there's any firm guideline, right? If you go look, like all the personal finance people, like will tell you you should have 6 months expenses, 3 to 6 months expenses could be there, but it depends on the organization, right? So, and it depends on what other things you have going on. So to give you an example, the board that I was on that I mentioned where I was managing the finances, one of our big issues was all of our donations were in dollars. All of our expenses were in euros. So, okay, that's a problem. And when I first joined, we had a big reserve in case something came up. But the finance committee decided to instead get into buying forward contracts. And so we knew exactly what the exchange rate for us would be 18 months in advance. At that point, we didn't need a reserve because it was fixed. We knew exactly what that translation would be. So depending a little bit on some of the things that you have in here, you might be more or less, but if I were rule of thumb, like 3 months expenses, it doesn't feel like a lot. And their expenses here are about 113,000 per month. So I would think, 3 to 500,000 would be a better number than 70. 70 is pretty low for this size organization. Yeah, fine.
There's also the difference between cash accounting and accrual.
Yes, what's the difference between cash accounting and accrual?
Cash accounting, cash is what you have on.
Cash is what you have on hand. Cash comes in, cash goes out. It's really clear. Accrual accounting does things like things that you're going to expect to come in.
That you haven't received yet.
And then you have things like, if you're doing accrual accounting, you have things like, oh, but what if people don't live up to their obligations? So like bad credit. People promise to pay you dues, but then they end up not doing it. Yeah.
So we show both. We have the accrual numbers, which don't look as good, but then we actually have the cash in the notes saying, look, we're at 98%, so far this year in cash, and last year we were 94% at this time of the year.
So what I've showed you here, and again, we've only got 1 or 2 more pages, and I am probably over time already or close. So this is a statement of activities, what you'll hear called a P&L elsewhere. There's also a statement of cash flows, because you might look fine here, but if all your dues were, say, coming in at the end of the year rather than the beginning, well, then how do I actually pay my people and pay my bills? So looking at, do we have enough cash, which is another good question to ask your VP of Finance or CFO. And maybe, like some organizations don't, there is a mismatch of when the cash comes in, and then you might have banking lines of credit or something like that that would help with that. But asking, do we have enough cash? Even if overall on average for the year we do, but can we make payroll every month? Right, like that's pretty important to people, so we'd want to do that. All right, let me cover 1 or 2 other things. And like I say, I am willing to do follow-ups with anybody. So maintaining financial policies. This is one of the obligations of the board. And so you should think about what are all the policies that we need. And here's some typical ones. Annual budget. What kind of reporting are we going to do? As a number of you have already discussed, are we going to have an audit? Are we going to have a review? It's not an obvious thing like, yes, we should have one, because there's real costs and real time that go into those. Level of reserves, conflict of interest, and what are your policies about financial controls? Those are some examples. But one of the things typically a finance committee or some subset or CFO should be having written of these policies, and they should get reviewed from time to time. You should know what they are as a board, or at least kind of where to get them. You don't have them off the top of your head, but I've seen them. I know they're there. I know where to get them. All right, let's go to the last one. And then setting strategic priorities, right? I think of this one as a big thing that often gets overlooked, right? Because we tend to focus on what's urgent, what's day to day. But it's really the responsibility of the finance people and then the board by proxy to say, are we on track for all of the things that we need? So if you happen to be in a building, are you accounting for depreciation? Because, even though you don't have to rebuild the building every year, like there's, buildings last 30 or 40 years. So 1/30 of the cost of the building should each year be a cost so that you're accruing that, or you have money set aside for that. Might be an example. But it's also things like big non-recurring expenses. You got to manage investments, thinking about different scenarios of what might happen in the future. What happens if Pfizer sells out of Ann Arbor and moves most of the Jews somewhere else? Like, that's a scenario that can happen. So who's thinking about those things and whether or not you'd be able to survive that? That is the obligation of the board or some subset of the board. And at a minimum, you as the board member ought to be asking, what are those priorities, and do we have plans in place for them? And am I confident that we have them? All right, I think that was it, right? Was that my last one? Yes. Question. 5 minutes. I know that was a lot to cover, so thank you. That I'm happy to take a few questions if we have time, and happy to follow up too. Any burning questions that came out of that? Are your heads about to explode?
I think it's interesting, with your statement of activities, you've got this $1.2 million budget. Well, our synagogue has a much smaller budget, which means that, we're gonna divide by 10 or by 20 on a budget, right? Then there's little we can have very small fluctuations that we can't tell if they're meaningful or not.
Yeah.
Because maybe the difference of $1,000 or one donation or something like that so sometimes it's very hard to track it when you've got smaller numbers.
It can be, but at least asking the question like, wow, last year we got 2 one-off donations of $1,000 each.
Are we gonna get those again?
If we're not getting those again, we have a problem.
Right.
That's, in your case, $1,000
Yeah.
might well be like the level of
10 or 20K somewhere
of
else. Yeah,
materiality that you want to look
Yeah.
at, whereas somebody else, it might be much larger.
Yeah.
That's absolutely right. Others, and now we'll get to the sexy part about raising the money.